Enbridge, the Canadian pipeline giant, is not just any company, it's an exciting investment opportunity for 2024. This firm is not your run-of-the-mill business, it's a thrilling prospect for those with an eye on the future. Picture a company that consistently generates and grows free cash flow, a company that recently celebrated its 29th consecutive year of dividend hikes. That's Enbridge for you. A recent dividend increase of just over 3% lifts Enbridge's yield to an attractive 7.7%. But the real difference maker is the firm's robust strategy for sustained dividend growth. Let's delve into why Enbridge is such a compelling investment choice. Firstly, Enbridge can beat inflation with ease. It has an income stream that isn't just reliable but also resistant to inflation. A significant 80% of its earnings are insulated against inflation, ensuring its annual dividend increases can keep step with the rising cost of living. Most of Enbridge's assets are subject to regulation, offering predictably inflation-protected rate hikes. The recent acquisition of 3 properties from Dominion further underscores the firm's commitment to securing utility-like assets, adding even more stability to its revenue stream. Moving on to the anticipated growth across segments, Enbridge's management is optimistic about 2024. They expect steady improvements in earnings and cash flow across all major segments. From the liquids pipeline to gas transmission and midstream, gas distribution and storage, and even renewable power, each segment is projected to contribute to overall growth. Higher pipeline utilization, recent acquisitions, and a focus on renewables prime Enbridge for sustained profitability. Financial health and strategic moves are equally crucial. Enbridge plans to refinance $7 billion of debt in the coming year, which will result in higher interest expenses. However, the company's inflation-protected assets provide a robust buffer against these costs. With a dividend payout aligning with management's goal of 60% to 70% of distributable cash flow, Enbridge is set for steady growth. The increased focus on utility-like assets supports this trajectory. The adage, "slow and steady wins the race," seems to be Enbridge's mantra. The firm's dividend payout falls within the 60% to 70% range of distributable cash flow, signaling a sustainable model for future growth. Management envisions adding around 3% annually to its distributable cash flow, translating into consistent dividend increases for shareholders. Despite near-term challenges, Enbridge's long-term strategy anticipates EBITDA and DCF growth, supporting low to mid-single-digit annual dividend increases. Lastly, Enbridge presents a bargain opportunity. The company offers an attractive dividend yield, and its stock is trading at a bargain. With an enterprise value of just 11 times the midpoint of 2024 EBITDA guidance, there's significant upside potential. Historical trading patterns suggest room for growth in the stock price, making Enbridge an enticing proposition for investors. So, to sum it up, Enbridge isn't just a dividend stock, it's a thrilling investment opportunity for 2024. With a combination of income, growth potential, and a strategic approach to business, Enbridge is poised to deliver returns that will leave investors smiling year after year.